Welcome to Highway Herald, your roadmap to the latest in auto. Today we're diving into the turbulent waters of the Chinese EV market. Once a booming sector, it's now hitting the brakes, with growth rates that are a mere shadow of what they were just a year ago. But this isn't just about EVs, it's a reflection of the broader Chinese economy, which is also slowing down. This spells out a long and arduous journey ahead for many Chinese EV manufacturers. So, is the Chinese EV industry on the brink of collapse? Let's delve into the top 5 reasons why alarm bells are ringing as the Chinese EV auto industry grapples with a market meltdown. Reason number 5. The Chinese economy is in low gear. The slowdown in the EV sector is a symptom of a larger issue. China's economy, after decades of remarkable growth, appears to have plateaued. With an aging population and high unemployment rates, boosting consumer spending, especially after the real estate sector's fall, is a significant challenge. The government has taken steps to inject liquidity into its banking system and stimulate its sluggish stock market. However, research firms like Capital Economics predict only a 4% growth in 2024. This economic shift won't occur overnight, and in the interim, EV companies continue to grapple with losses. In the last quarter of 2023 alone, NIO and XPeng reported net losses of over $600 million and $500 million respectively. Profits are rare, especially in the wake of the price war. With the Chinese economy slowing down, it's unsurprising that the automotive market has also peaked. The best sales year was 2017, with 24 million new vehicles sold. Last year, that number dropped to around 21 million. In this climate, EV makers are finding it increasingly difficult to stay afloat, and attracting new investors is becoming harder. Major Chinese EV companies like NIO, XPeng, and Li Auto have seen their stocks plummet by 40 to 65% over the last several months. Reason number 4, the battle of prices. With the deceleration of EV growth and the overall car market having reached its zenith some time ago, it's no surprise that many companies are pulling out all the stops to stay in the game. The Chinese car market, vast as it is, appears oversaturated, especially when it comes to EVs, which make up about a third of the total market in the world's most populous nation. Growth has significantly slowed down to around 30% year over year, indicating that the pool of new customers is dwindling. Consequently, most car makers have entered a price war. We're not talking about minor incentives like free charging or insurance, but massive discounts. This is a war of attrition, where the biggest and most powerful companies believe they can outlast the smaller ones and eventually dominate the market. The goal is to emerge from this price war victorious, but at the moment, everyone is hemorrhaging money. Take a look at the major players. BYD has cut prices by 100% or more, while companies like Li Auto, XPeng GAC, and SAIC are also offering hefty discounts. The ongoing price war has even drawn in foreign players, as survival necessitates participation. The Volkswagen Group, a dominant force in China for decades, is now compelled to offer substantial discounts, particularly on Audi models, which are now 50% cheaper. The same goes for BMW, while Japanese companies like Toyota are also slashing prices on their vehicles. Before we delve deeper, we'd appreciate it if you could subscribe to Highway Herald. Your support fuels our passion to create more content like this. Now let's explore reason number 3, BYD's downward trend. BYD stands as the largest EV company in China, and likely the only one that consistently turns a profit. It's seen as Tesla's main competitor in terms of technology and sales. However, it too is feeling the pinch of domestic market oversaturation. The issue with BYD is that it has struggled to carve out a position in the global market. It does sell some cars in Australia and Europe, but the sales figures are far from impressive. As a result, 95% of its production is sold domestically. With the current slowdown, it's no surprise that the biggest players are hit the hardest. In February, BYD sold just around 50,000 vehicles, a significant 37% drop compared to the same month last year. It seems that even massive discounts aren't helping much, as a slight decline is expected for the entire year. Given these circumstances, it's not surprising that the stock value has dropped 23% over the last 12 months. As a result, the chairman and chief executive, Wang Chuanfu, suggested that the company should buy back its shares to boost the stock price. According to recent reports, the company plans to spend $55.6 million on buying A shares. Reason number 2, giants stumble, Minnows on life support. When the titans of the industry are faltering, one can only imagine the plight of the smaller players amidst this colossal market meltdown. The struggle is real and has been ongoing for years. Rewind to 2017, and there were over 500 registered EV makers in China. Fast forward to today, and that number has dwindled to around 90, a figure that's still up for debate. Experts suggest that a significant number of these remaining manufacturers are essentially non-operational. Some manage to sell a meager 500 vehicles quarterly, while others can't even hit that mark. Reports indicate that only 20 companies operate at 60% or more of their production capacity. Given that the top 10 EV sellers in China command 80% of the market, it's hardly surprising that the rest are essentially on life support. With the ongoing price war, bankruptcy seems to be the inevitable fate for most. Reason number 1, the carnage commences. Warnings of a sea of blood engulfing the Chinese EV industry have been circulating for a while, and it appears that the tide has finally come in. Consider the indicators we've discussed in this video. The market is decelerating, stock prices are plummeting, and even the industry giants are floundering. Need more proof? Look no further than the recent wave of bankruptcies. In just the past few months, 5 or more EV makers have declared bankruptcy, and we're not talking about minor players. We're talking about companies like Evergrande New Energy Auto, once a promising EV company that's part of one of China's largest conglomerates. Despite massive investments, this EV maker never managed to carve out a significant market share. Whether it was due to a lack of technology or a flawed business model, the company declared bankruptcy. In the final analysis, it turns out that the company lost $17 million on every vehicle it ever sold. Then there's WM, a startup that began with a respectable $5.3 billion capital, but even that wasn't enough to establish a sustainable business model. Today, the company is essentially defunct, despite its active pursuit of new investors. Speaking of investors, let's not forget SAIC, a Chinese state-owned company that's also struggling significantly. It's currently seeking new investors, and the fact that a state-owned company is now on the private market is quite telling of the state of the Chinese economy. The CEO of Li Auto, one of the leading EV companies, probably summed up the current state of the Chinese EV industry best. He stated that companies need to band together or they won't survive, given the oversaturated domestic market. He also emphasized that the government needs to intervene to prevent a wave of bankruptcies. Otherwise, most of the remaining companies will cease operations soon, especially in the wake of the price war. The entire Chinese automotive industry is in panic mode, and it's now up to the government to face the new reality and take appropriate action. Thank you for joining us on this journey through the world of vehicles. Don't forget to subscribe to Highway Herald to stay updated on the latest vehicle updates and upcoming videos. See you next time.